Okay, I think we just made it on time. I know that most of you are going to the results presentation next door. I think I'm told that they start at 11:30, so we'll try and go through as much as possible through our presentation, and obviously we'll welcome for questions at the end as well. I hear somebody's phone going off. Please could I ask that maybe we just have our cell phones on silent or vibrate or off preferably, so that we can don't get too interrupted. Ladies and gentlemen, thank you very much for joining us today to hear what we've been going through over the last 6 months for the period under review. But before I start, I just wanted to take a couple of minutes and provide a perspective of the very, very tough trading environment that we've been trading under, and more importantly, where and how it has impacted our business during the period under review. I'll also spend some time on how these factors shaped our strategy, because clearly with all the socio-political and issues that have been going on in the country at the moment, it's in everybody's top of mind in terms of how does that impact Delta going forward, and obviously are we getting rentals? We do need to address that as well. If I just take you back, for those of you who are new to Delta, Delta listed in November 2012 with the objective of carving out a niche as the JSE's dominant sovereign listed REIT. Today, we have a portfolio of 11.3 billion rand with a total GLA of some 973,000 square meters. We have not only achieved that goal, but I'm also wisely advised that we are the third largest provider of office accommodation on the stock exchange, which sometimes is not a good thing. But we tend to say that being in the sovereign space, it negates any downside exposure that a traditional office accommodation portfolio would have, as we will hopefully through our presentation, and as we've been saying for the last 5 years since we're listed, that sovereign is a sticky tenant. They generally don't move. We have a pretty high percentage of retention of our tenants. Let's now deal with the operating environment and how it has impacted the fund. As at the end of the reporting period, unfortunately, we had 33.4% of our portfolio were based on a month-to-month. This is predominantly based on the national tenants. What we've seen is an extreme, almost a grinding down of the National Department of Public Works. We haven't really seen any renewals or new leases coming out at national level, which is obviously very, very concerning for us, because I know that at the last results we did share with shareholders that we had submitted some 243,000 square meters of GLA that was up for possible renewal on a bulk proposal, and I'm sure you'll hear from Jeff and his team as well. They participated in that, and we had a quick chat before we presented, and we are all eagerly awaiting the outcome of those renewals from government. What that is translated, as I've already mentioned, is that 33.4% of our leases are on a month-to-month, which is obviously not great. To add further salt to the wound, there has been some recent changes within the PMTE unit, which was previously staffed by private sector individuals, with the head Paul Sirote, who basically resigned about 2 months ago. We still are trying to engage with DPW to see what changes or how that will impact the long-awaited policy that is outstanding, and whether the policy will get signed before the end of the year. And obviously that has a huge bearing in terms of a stock like Delta, whereby we've got about 76% of our income comes from government. So we very much are at the forefront of pushing and making sure that that policy does indeed get signed off. As I've already alluded to, government tenants are unique in terms of size and location. And I think we've previously, and I know that the CEO, Otis Shabalala, will take you through various slides that show you the nodes that government or government tenants need to be in the CBDs with regards to location. So we historically have bought assets in the right locations and hopefully at the right price. Unfortunately, where we play, most of the type of assets that we basically have bought do need a fair amount of capex. And with the delay of the renewals, that has delayed our capex program. Despite the delay in the signing of the lease policy, DPW recognizes that renewals need to continue as serious backlog. I mean, if you remember, we've just come out of a period whereby we had 2 periods of National Treasury dispensations, whereby to try and help DPW with their delayed 3-year or unsigned leases, Treasury gave them a 2-3 year periods whereby they can catch up with the backlog. Unfortunately, as a result of the non-signature, particularly at national level, we are seeing that that scenario is playing itself all over again, where a fair amount of leases at national level still remain unlet. However, we have it hasn't been all doom and gloom. I think we shareholders will obviously remember that we have started to focus at provincial level and at local government level, particularly in the Pretoria CBD and the eThekwini municipality. Those are the 2 municipalities that we have exposure to, and we have seen some traction there. And I think some of the numbers that we have announced on the renewals and on the new leases have predominantly been at provincial and at municipal level. We have basically, we did mention that we were busy with Commission House, which was long vacant. That was 7,000 square meters of GLA, which initially, when the tenant moved in, they were looking at 3 years. They have since put up an application to DPW to extend that lease to a 9-11 month lease. That lease is currently done at 105 rand a square meter with a 7.5% escalation. Similarly, we entered into new leases with the eThekwini municipality for 3-year terms. At the embassy building, they took up 17,000 square meters, as I mentioned. One of their buildings got condemned. What we have seen of late is a very, very active Department of Labor, which basically has been going around condemning buildings. And we were quite fortunate in the eThekwini municipality that the municipal building, one of the municipal buildings, was actually condemned by their labor department. And basically, virtually all those tenants we were able to house at our embassy building. At Delta Towers, we signed new leases of 7,000 square meters at 85 Rand. I think I've historically said this, that the type of assets, and if you look at the positioning of our assets around the eThekwini municipal, the town hall, all of our buildings are very, very well strategically positioned. And we're seeing a lot of queries and a lot of traction, particularly from provincial government and the eThekwini municipality. But obviously, last week, Wednesday, Minister of Finance then stood up and, pretty gave a very dull and gloomy picture to the country. And since then, we've been answering a few calls in terms of how that impacts Delta as government goes further down the austerity measure. You would have seen as part of our results, those of you that have had a glance of the SENS announcements that we announced early this morning, that despite all of that, despite all the socio-economic and socio-political issues, our debtors days across the portfolio are still at 18.1 days, which is extremely good for a portfolio of ours, predominantly which is underpinned by government and is office-oriented. So government do pay. What we've seen is that government generally pay salaries, and the other thing that they do pay is their rental. I think where they do lack, as you will pick up, is their ability to renew these leases. We have historically mentioned that it takes about the DPW about 18 months to renew a lease. So we've basically been lobbying Department of Public Works so that it actually doesn't make sense to give us these 3-year leases, whereby immediately you sign a 3-year lease, you automatically start going into a lease renewal discussions for 18 months for half that lease. So for us, it makes absolute sense that long-term leases should be brought back. We are pushing very, very hard that the long-term leasing policy, or the policy that has been circulated within the industry, does get signed off. That policy has been through all the industry, it's been through all the committees within Department of Public Works, and has only got one more signature, which is that of the minister before it becomes law. And as soon as that comes through, obviously I think we'll be the first ones to make sure that we obviously communicate that. But it's not only, as some of our shareholders have pointed out, it's not only about the signing of the policy, but it's about implementing and actually physically signing the renewals, which is more important. I see some of our bankers in the audience. The policy is one thing, and this is what Rob and Vanessa keep telling us, that some of the things that they want to see is actually the renewals, not the policy. Yes, policy certainty is absolutely crucial for shareholder certainty and obviously quality of earnings going forward. But that policy needs to be translated into action, and I think certainly you'll find us at the forefront in pushing for that. Obviously, after the speech by on the midterm budget speech, there's a high likelihood of a sovereign downgrade. There has been questions, again from concerned shareholders, how that will impact Delta going forward. During the 6-month period, our cost of debt has increased marginally from 9% to 9.2%. It should, however, be noted that the expiring swap contracts were originally concluded at a historically low base. Further ratings downgrade and our current month-to-month lease profile will no doubt obviously have an impact in terms of the fees or the margins that our bankers will charge us, and we are fully cognizant of that. But I don't want to take too much thunder from Shanil's show there. He will take you through in terms of what some of the facilities that we have renewed and at what pricing that we have basically renewed. Also, the downturn in the economy, we announced a pretty substantial 1.3 billion rand disposal program around about 10 to 11 months ago. That have initially started off well, as the easier assets were easier to sell. What we have seen of late is that the assets that we have are becoming more and more difficult as funding institutions tighten up on credit facilities, on new entrants, new buyers and new players into the sector. So we're finding it slower and slower to obviously dispose of the assets that are remaining. But it doesn't stop us from trying to continue to try and find various alternatives for those particular properties. I think one of the probably new promising shoots that we've seen, maybe it's an effect of the current economic climate, is that we've actually seen quite an interesting turnaround where we've started seeing some pretty sizable listed corporates moving back into the CBD. A case in point is the recent lease that we've signed with Mr. Price. They basically have moved in their call center in Durban CBD at our building at Liberty. They've signed a 10-year lease basically, and that deal was done at 108 Rand a square meter with a 7.3% escalation. They took over the space where historically we had Edcon. Obviously, Edcon has been going through a tough time with their turnaround strategy. So I think for us it's quite pleasing to see that the corporates are no longer running to places like Umhlanga or Sandton and are starting to find value, particularly for their call center or back office staff at more cost effective CBD-based properties, basically. Also, the other advantage is that the CBD is obviously in very much central into the transport nodes. So some of those people, it becomes quite difficult to catch 2 or 3 taxis to move from Soweto to get to the CBD of Joburg, to catch another taxi to Sandton. Obviously, that has a cost impact in terms of employees. So employers are starting to realize that they obviously need to try and meet their employees halfway and save cost as well. Just to come back to the policy, the indications are that this policy will be signed before the end of the year, and that speaks to the BE transaction that we have approached shareholders on, and we already are on the front foot to make sure that as and when that policy does get signed off, that Delta does not lose out in any renewal process, as there is serious talk of long-term leases as we've been engaging with government. I've touched on the refinancing costs, which remain under pressure from a result of the month-to-month leases. And Delta has also received approval to enter into a 5-year lease with a renewable option at Shell House. This is also from the city of the eThekwini municipality, where historically this is one of the buildings where we bought from Redefine, which constituted part of that 600 million rand capex that we needed to spend. The lease has not quite hit our desk yet, but that particular lease has been through council and has been approved, and the minutes have been sent through to us, and we're waiting for the process to basically work itself through. The intention is that hopefully at that stage we would have recapitalized the balance sheet so that we can start impacting some of the contractual lease obligations with regards to some of that capex. I think when we came out with our guidance, before I go into the presentation, when we were doing our roadshow for the full year last year, we did advise shareholders that we expected a flat growth on distribution this year. I'm happy to confirm that that guidance is still in place. Despite that, we've seen a worsening of condition during the period. So despite that, the fact that we had already budgeted for some of the revisions into our budgets, obviously, I think will stand us well. On the flip side, the benefit is that the longer these renewals are delayed, we do see some small benefit as the tenants pay a slightly higher rental. But I'll let Shanil continue with that. With that, just high level, I'm trying to give shareholders a sense in terms of the tough economic environment that we've been trading in, so that when you look at the results that we are about to present, you've got some sort of sense, all the issues that are almost external to our business that we've had to deal with, that this management team and through the leadership of our board, and we thank our chairman for making the time to be here today, to obviously guide us through these very, very tough and troubling times. Just a quick introduction. The quick stats is that we remain pretty highly sovereign focused. We still are 75.9% of our revenue is coming from sovereign tenants, and I think the fact that they're paying, I think, is still justifying to us that despite the tough economic environment, the guys are still paying their rentals. The only missing link now in this whole story that we're about to tell you is basically the whale. You will pick up later that our whale is a bit is something that we are focusing on, and I think we've been working on for some time. I think we redid our credit rating with GCR. They have taken quite a positive view with regards to the policy and where Delta may come out, particularly if our BE transaction is successful with shareholders. And I think they've opted to basically maintain our BBB long-term rating and our A2 short-term rating. The fund is still very much dominant in Pretoria, where most head offices of government are. And as previously mentioned, we are now the largest landlord in the Durban CBD, where we basically have become the market setter. Our average property value per property, this is a number that I think I've mentioned through the various reporting periods, has ticked up slightly to 104 million rand. And the reason why we mention that number is that is linked up to the size of property. What we find, and it's been a strategy that we've deployed very, very successfully from a tenant retention perspective, is that the bigger the building, the more difficult for the tenants to move around the CBD and find alternative accommodation. And so, despite the fact that 33% of our national leases are on a month-to-month, we found that the tenants have basically had no other alternatives but to stay in our buildings. And actually, once we recapitalize the balance sheet, the intention is very much to refurbish these buildings so we can basically retain most of the tenants. This was just a highlights since listing. I think the key point there is obviously the proposed 4.7 or 5 billion rand BE transaction that we're anticipating. And just on that, I think we got word that I think from our funders that we basically are left now with one more with one more committee to go for that particular transaction to go through. So I think it has taken a bit of time. It's taken slightly longer than we would have liked. The intention was to have that transaction and the full terms announced by the time that we came to our results. But again, being that they're a public entity, they also had some of their issues, and thankfully those seem to have died down a bit to allow business to continue going forward. With regards to the period under review results, which were part of our SENS, the board has approved a distribution of 46.40 cents per share, which still keeps us in line with the guidance that we've given. And I think historically, as we've always mentioned, the bulk of our escalations actually take place in the second half of the financial year. So we are still very, very bullish that the guidance that we've given will remain in place. The total distribution that was paid out in terms of cash that was paid out to shareholders, that will be paid out to shareholders, is 329 million rand. And I've already mentioned the very well managed debtors days, particularly in this current environment, and particularly given that there's a lot of nervousness about austerity measures within government, that we still are achieving 18.1 days of debtor days, which is, I think, very, very good. And I think it doesn't come easy. We are one of the few funds where we have a special team that only deals with collections and leasing at National Department of Public Works, or government as a whole. And that team has been working around the clock. And I must thank my colleagues for working tirelessly to make sure that our debtors days don't look. In fact, I think I'm very proud on the 18.1 days. Our vacancies has ticked up slightly from the full year. I think we were about 9%, if I remember. We've ticked up to about 11.3, which is still just below the SAPOA average for office at 11.8%. So we obviously do try and manage that. We have lost one or two tenants in the Free State, but I would let Otis touch on that. On a positive note, whilst the national government is basically, or national department is basically not signing any new leases or renewals, provincially, as I've already mentioned, we've signed 71,000, close to 72,000 square meters of GLA, which is again a huge effort. In addition to that, we've concluded 48.5 new leases, with a combined leasing performance of plus minus 120,000 square meters. I think in this economic environment, I think that is definitely a job well done. Certainly, I know that we are not alone, and some of our peers are also struggling, particularly those that play in the sovereign space as well. Just a quick look before I hand over to Shanil on the balance sheet. And I think, we have already mentioned some key numbers, but this is the one key number that is absolutely concerning us, that our WALE is sitting down at 1.8 years. That when we listed with a WALE of 7 years. And through the years and through the various administration at DPW, we've seen that come down gradually. And the reason why it's come up slightly from year end is we did some major relates, as I've already mentioned, particularly with Mr. Price, particularly on the retail as well. But that is a major concern of ours, and it's something that has a huge bearing in terms of how our funders look at our sustainability of our debt, and obviously a certainty of income. Having said that, I think we have a high percentage of retention of our tenants. I think bar the two tenants that we've lost in Bloemfontein, I think that we have basically retained most of our tenants around the country. The other number that I haven't mentioned here is a slight uptick in the loan-to-value. Again, Shanil will touch on that as part of our refinancing program that we've been extensively working around the clock to try and find a solution, whilst letting funders and shareholders know that we do have plans in place. Our proposed BE transaction, I think it will be a major catalyst for this particular fund in recapitalizing this balance sheet. And hopefully by then, DPW would have got their house in order, that the long-term leases will obviously improve, and that will obviously have a positive impact on the WALE. The two go hand in hand. At this stage, we are almost toying around with the idea that if the funding does come through from our funders, we get the right credentials. Let's recapitalize the balance sheet and come to shareholders with a stronger balance sheet going forward. As obviously, it is becoming extremely difficult to negotiate and convince banks, as we've been saying for the last 12 months, that this whale needs to improve. And the last thing that we can afford is for our funding partners to basically lose patience, particularly on that whale. Let me hand over to Shanil. I'll be back at the end just on the conclusion and maybe also to take some questions as well.
Thank you, Sandile. Thank you, ladies and gentlemen. Once again, it's a pleasure to see you guys here attending our results presentation. I think we as management are once again very, very pleased with the results that we've achieved for the interim period. And I think as Sandile has mentioned in his introduction, it's been quite a tough trading 6 months, especially from a financial perspective, with the debt renewals, together with a lot of other factors affecting the business, particularly with the lease renewals, that has quite a significant impact on financial factors in the business. So I think as a management team, I think we've done fairly well with what we've achieved. And I think just to take you through some of the highlights, which Sandile has obviously touched on, but I'm just going to give you a bit more complexion around some of the numbers. So, one of the big numbers in our lives that we live by is the LTV, 42.3%. So, since financial year end, 41.5%, we were obviously hoping to have improved on this number. Unfortunately, for us, there were quite a few factors that didn't materialize during the period. Once again, speaking to the tough economic environment, and again, to our disposals program, which obviously didn't materialize as planned. We were hoping to obviously settle quite a bit of facilities, generate quite a bit of free cash that would have went quite a bit to settle the debt facilities and generate some positive cash that didn't materialize for us. On the downside, some of our investments that we've had, our listed investments in associates, as well, being affected by the general economy, like most other listed shares. Values have deteriorated, so we've lost a bit of value there. On our disposal sides that we did manage to conclude, obviously that has dropped some of the asset value and some of the cash that we did generate from there. We have had to put back into the business. And that again speaks to the fact that obviously some of our access to funding hasn't been as abundant as the past. So we've obviously had to use some of that cash in some of the operating costs within the business. Also, we've had a disposal of quite a significant investment, a foreign investment that we've had in the prior financial year. So our LTV calculation takes into account loans to related parties. That was quite a significant value in respect of a loan that we had of 50-odd million rand. So all of that in summation effectively is what deteriorated this metric for us. That has brought it down to 42.3%. I guess for us, looking forward to financial year end, we still believe we would like to see this number improve further to financial year end. We are still hopeful that we could try and bring this down. Maybe not as close to the 40% as we would have liked when we started the financial year, but it depends. Things could change. So I think for us, this is still quite a key metric for us financially and how we're going to improve on that. Refinance, 715 million. I think this has been obviously quite another key element and has been keeping us quite busy financially in the business. Just to emphasize on the 715 million. 156 million and 125 million rand of this value is what was done post the interim period. So it's up to our results presentation as of today. Those two big numbers, one is our 125 million rand unsecured note in the DMTN program that we've had to settle. So that was an unsecured note. We've effectively used vanilla funding to settle that. There's a further 156 million rand, a dollar-denominated loan, $12 million with the Bank of China, which we've also refinanced in October. The balance being bank facilities, which I will give you a bit more detail further on in the slide. From a fixed perspective, I think we've always told the market that we'd like to keep this number above 80%. So I think even though you do see the ratings, the potential rating downgrade that are coming through, we've got about 82% of our debt that is hedged. It did deteriorate slightly. We had 160 million rand fixed that expired in April. And I guess here, again, we're going to remain opportunistic. We'll just have a look for further value that in respect of contracts going forward. And if there's further value, we will obviously execute on that. I think Sandile has really elaborated with regards to debtors. There's a lot of effort in the business that goes towards collection. And I guess that's what our business is based on, obviously renting out space, collecting and distributing to shareholders. So this is fairly key for us to ensure that we're on top of our game. And we work very, very closely with government, especially if there's any arrears, if there's any queries, we ensure that we're on top of it to make sure that that any queries are timelessly addressed. Operating margin, that gives us a 26.2% gross cost to income ratio. I think that's fairly respectable. We're operating fairly well. So I think that just demonstrates that, from a cost to income ratio perspective, we are managing the business fairly well. Interest cover at 2.4. So I think here as well, just from a rounding perspective, it's actually 2.42 versus 2.47. So from a bank covenant perspective, another critical ratio, at 2.4, we're well above the covenant levels of 2 that's generally required. So these are just some of the financial highlights. Okay, and then I think just from a financial review perspective, just to speak to our revenue numbers, you would see that our revenue, 3.3% increase in our revenue. And I think here as well, just to give a bit more color to this increase, we obviously did have disposals during the period. So if you're just looking at a like-for-like comparison, and I think that's also something fairly key that our shareholders look for, is that if you look at the disposals that we've concluded, the disposals have actually impaired, so I use the word impaired in inverted commas, impaired the revenue by about 3.4%. So had we not had any disposals in the business, you would have seen a 6.7% increase in revenue. So I think that's just to say that that's the effect the disposals have had on the business. And if you look at the net property income as well, there you will see effectively the increase that we've had of 4.7%. There again, on a like-for-like basis, we've actually increased by 6.8%. So for those that follow the like-for-like increase on the base property portfolio, you would understand what I'm trying to emphasize. It's a 6.8% increase if you had to exclude the disposals. Finance costs have increased, but there again, like Sandile has mentioned, we've obviously had a slight uptick in debt level, minor. It's about 30-odd million rand, that increase. But we've also had some significant swaps that we concluded during February, where we saw value, and where we had swaps that expired. The swaps that we did conclude, a much longer tenor, 4 to 5 years, and we did that on an average between 7.8 to 8%. So where you had the expiring swaps at a much lower rate, this came in slightly more expensive, but obviously we took the more expensive rate looking forward for the next 5 years, which obviously gave us a lot more value in Feb this financial year. Cost to income ratio, like I mentioned, from a gross perspective, 26%, 26.2 still well. Cost to income has ticked up slightly. You would recall the interim period last year, we had just acquired the redefined portfolio. So it was still being bedded down in that financial year. So a big part of our cost to income ratio increasing is an increase in operating costs that we have experienced in the business. That's impacted. Investment property, the movement, fairly marginal, but I mean the factor here is obviously the disposals netted off against capex. So, we've had disposals of about 140 odd million rand, and you've obviously had capex that have been capitalized onto the property. So that results, that gives you the net movement that you see between the period. Listed securities, this is obviously our investment that we have in Grit. For those of you that are aware, Grit obviously had their rights issue. We, unfortunately, due to our own cash constraints, could not participate. Accordingly, we were diluted. We are now shareholders. Our current shareholding is 11.5%. So we are now, our investment is not as significant as it was. We're sitting at 11.5%. And I think Sandile probably in his conclusion will touch a little bit more about our long-term strategy around Grit. Borrowings, like I've mentioned, hasn't been any significant increase to the period comparable in the prior year. It's a slight increase of 30 million. Loan to value, I think I've mentioned quite a bit around that. Interest cover as well. Weighted average interest rate, there again, up to the interim period, and I mean, this number is obviously up to the end of August. We have had one in respect of our facility renewals. And again, with regards to the whale in the business, it's obviously impacting our credit rating within the banks. So we are seeing an uptick with respect to our refinance rates. And it does have an impact, but up to interim, the amount of facilities that we've refinanced, it hasn't been significant thus far. But in the next financial year, I mean, in totality, if you look at the next financial year, we've got about 1.8 billion rand that comes up for refinance. So, I mean, if you look at a 5 billion rand debt profile, you're obviously going to see a lot more movement depending on where we get with the refinance and how our credit rating is matched with the respective banks and the refinance rates. So I think for us, that is where the real critical mass and measure comes into play, is we really need to obviously try and ensure that these policies are signed so our overall risk rating is improved to manage that cost. Debt expiry, again, another measure that's very closely correlated to the whale. So we obviously see an improvement once we obviously get the lease expiry profile extended as well. The debt fixed expiry as well, the period of time that's been ticking down, there again, there's quite a correlation between the whale again and your debt expiry period. Fixes, I've mentioned that. Net asset value, you would see that has come down slightly. I've got a net asset value bridge that will give us a bit more detail around the reduction in the NAV. Just on the distributable income statement, this is just giving you some ideas to how we reconcile from the net property income down to the distributable income. So you would see in respect of the net property income we've touched on. Administrative expenses, we've had about an 11% increase. So here you've obviously got your CPI increase that impacts you. We've also got, with regards to asset management fees, obviously with respect to the calculation being the enterprise value, the slightly higher debt level, and obviously with regard to the share price in the business. So that calculation, if you had to consolidate, has resulted in about 50% of the increase. The balance is that you would recall that we've had vacancies, the board vacancies, also in the last financial year with regards to the executives. I mean, Otis's appointment happened in June last year, so he's obviously costing us quite a bit this year. He's been here for the full 6 months, so that's the other 50% of the increase that we've got in there. The net finance costs, sorry Otis, I'm just kidding. The net finance costs, I think like we mentioned, it's about a 3.8% increase, but obviously quite correlated to the cost of debt and the swaps that we've got in place. Dividend income, if you look at the income from Grit, so yeah, this is a factor of the foreign exchange rate, obviously. If you had to just look at the dollar distribution, it obviously has increased, but it's just a factor of the foreign exchange rate that it looks slightly lower. Sundry income is just bad debt recovered. And obviously, if you would recall at financial year in Feb, we did retain some of the distributable earnings. We decided to obviously distribute it at this interim period. Had we not distributed this, then our distribution per share would have remained almost flat to August 16 last year. And I think the decision was taken that we just release it at this stage here. Okay, this is just a graph that just depicts with respect to the distribution growth, just to show you the progression since 2013 all the way up to Feb 18. You would see that from a H1 perspective, this is our target for the full financial year, as we've communicated to the market, 97.24. We're currently at 46.4. And I think as Sandile has mentioned, we are fairly positive. We are on track to meet full year distribution guidance given to the market. I know Sandile has mentioned that, with the lag in the policy being signed, we should see a little bit of positive from a net property income perspective. However, there is a negative in the fact that vacancies in the business have ticked up. And there's a certain element of vacancies that we have forecasted for in our guidance that was originally given to the market that hasn't materialized. And I think Otis will flesh that out as well when he gets to his presentation. But I think particularly for most of you guys that are familiar with the property nodes, especially in Sunninghill, we are really battling with that node. We've got 3 significant buildings in there, and that's really costing us quite a bit. So with the benefit of not having the reversions coming in place, together with the uptick in vacancies, we are at this stage probably still going to keep our flat guidance forecast for this financial year, unless something else significantly turns in the next couple of months. All right, and this is just the distributable earnings bridge. That just shows you how we've bridged the gap between interim last year to interim this financial year. It just shows you all the positives, the increasing bridges, and then obviously the erosion that was taking place. Obviously from sundry income slightly down, dividend income. So this is effectively the comparison of what Grid contributed last year versus what they've contributed in this financial year. Our admin costs that have gone up by 4.6 odd million rand, that's the 11%. The net finance costs, that's the 3.8%, the 8 million rand increase. And obviously what disposals have eaten away from our distribution. And that gets you to our 329 million that we are now distributing at August 2017. So the like-for-like comparison that I alluded to earlier on, this is just to show you again. That's our net property income at August 2016. Net property income at August 2017, 576. That's a 4.7% increase. What we're demonstrating here is the effect the disposal has actually had. And if you get to the bottom, you would see that's the 6.8% like-for-like growth we're talking about. So you would see the 41 million is after taking out the effect of the disposals. The time waiting that we speak of here, we did have one redefined building, Treasury House, which transferred in August 2016 last year. So obviously it contributed for just 1 month of the last year period, but for the full 6 months in this H1 period. So this is effectively where we've just time weighted the difference, and that's the additional contribution. So on a like-for-like basis, and I think what we're trying to demonstrate here, you would recall with regards to our snapshot in the last financial year, we did say that our in-force escalation was about 6.8, 6.9%, and I think this just demonstrates that we are achieving our in-force escalation of what was actually put out to the market in the prior financial year. Okay, and then just the statement of financial position, the balance sheet. I think we've covered quite a bit in the snapshot. There's not too much more that I can elaborate on, with regards to the investment properties that we've got, the fair value, the straight lining, the investment in associate that we've got. So obviously what you see on the financial position is the equity accounted position. And what we use for LTV is obviously the market value, being the value trading on the JSE. You would further recall that last year sometime we were planning to migrate the shareholding onto the SIM. We decided to hold that shareholding on the JSE, and that was the primary decision taken was that there's better liquidity on the JSE, and I think from guidance from our funders as well, they would have preferred that we hold the shareholding on the JSE. So it's trading on the JSE. Non-current liabilities, I mean, a big part of that is obviously the long-term portion of your debt. Current as well is more the short-term portion of our debt that's expiring within the next 12 months. That sits in that number. Okay, so the net asset value bridge that we've got, again, this just demonstrates what has actually eroded a bit of the net asset value from the 991 to the 974. So I guess that, just to emphasize, you would see the disposal and some of the fair value adjustments that we've had. And these fair value adjustments that we've had comes out of our interest rate swaps. You know, we did settle a cross-currency swap in March that costed us about 9.5 million rand. So that's a big component of this. We've had a further 21 million rand loss, fair value loss, and that's purely on the mark-to-market on the interest rate swaps that we've had in the business. So that's a combined 31 million rand loss. On the disposals, again, that comes out of some of the disposals on the assets that we've done. That on the 140 odd million rand, it was just under 14 million rand worth of losses that we incurred, which is still quite commendable. You know, in respect of the haircut that we've taken, it's still within the 10% mark that we did communicate to the market. In fact, I think we gave a guidance of we would have been happy with the 20%, up to 20%. So I think we achieved fairly well. The bigger loss that actually came through was on the disposal of our UK investment in Baystone. And I think that costed us quite a bit. You know, that almost was about 40 odd million loss, fair value adjustment loss that we took on that investment. But I think at that stage, it was fairly opportune. I think we exited at the right time. You know, obviously finding a buyer in that market for the investment that we had was quite difficult. So these two components obviously have what significantly gave us the 991 to the 974 reduction in the net asset value of the business. The debt summary. So here again, I think this just highlights and gives us some of the detail around what the debt of the business looks like. You know, with regards to our bank facilities, you would see we've got about 4.9 billion, floating 3.5, the fixed, the revolvers. The DMTN, this 125 million, like I've mentioned, that has now been settled. So that is effectively rolled up as part of the floating bank facilities. So our DMTN program, 2 billion rand, is currently unutilized. With regards to our fixes, 3.6 billion, and that gives us our 82.3% that we've got fixed. So here, to get to this number, you obviously remove the revolvers, and you take this percentage, excluding the revolvers, from the 5 billion, and that gives you your 82.3% fixed. I think the good things for us as well, with the Bank of China, that's not obviously split separately, that's $12 million. We've managed to renew that facility at the exit rate, which was effectively the 6-month LIBOR plus the 3.5%. So I think, you know, we're fairly happy with the refinance rate that we've achieved on that facility as well. This is just a graphical representation of our debt analysis, just to show you the sources of our funding, the classification of our debt, and just our financier split. You would see the major players in our lives, so our big shareholders, Nedbank, Standard Bank, Investec, Bank of China. Our debt expiry profile, you know, from this fixed bank facilities, and I think the next slide I'll give you just a bit more color as to what remains. We have done further renewals, or we've signed further term sheets for a further 365 odd million rand with Nedbank. So that obviously, I think to financial year end, we've just got just under about 100 million rand left. But I think, like I emphasized again, the major, not concern, but I think the major effort is going to come in for the next financial year, being 1 March 18 to Feb 19, because that's where we've got quite a significant amount of debt that's coming up for renewal. So this is just the debt expiry profile. So just to the 360 that I mentioned, these two, I think we've now concluded with Nedbank. We're at the final stages of signing the refinance. That just leaves us with these two tranches, which I think we're also fairly advanced in discussions. The Bank of China is done. So this is within the first 6 months of the next financial year. You would see quite a big task. It's 1.2 billion. And after August 18 next year, there's a further just under 700 million to go as well. Here again, as we've been speaking to and as we've been communicating to the market as well, should the balance of our disposal program go as planned, quite a bit of that cash will be used towards the settlement of debt. So, we're still hopeful that if we gain traction, we will be able to do quite a bit of settlement against some of these facilities that are coming up for renewal. Okay, and I think this is just some of the commentary, with what we refinanced. I've touched on the 125, the 156. This is just elaborating on the 42.3%, like I mentioned. The devaluation of our investment, the loan was based on what has really impacted the loan-to-value ratio and that depreciation effectively. Again, just to give some definition to the 9.2% versus the 9% as of August 2016 last year, the fixed debt and the average debt expiry and the metrics, where that actually sits. Okay, thank you, and I hand over to Otis.
Good morning, ladies and gentlemen. Thank you for joining us. It's always very difficult to speak after my CEO has very well articulated the operational side of the business. Shanil, I'm going to come back to you. We have a nickname for Shanil. When he behaves himself, we call him Praveen Godan, and sometimes Malusi Gigaba. And when he misbehaves himself, Mandla, you know what we call him. Atul somebody. We might now want to add Trevor Noah with the jokes you're cracking. No, but good morning, ladies and gentlemen. I think thank you for taking the time to come out and listen to our result presentation. I'm here to take you through the operational side of the business. I'm going to cover 5 key areas, being the DPW and the leasing policy. I will touch on the leasing, both new leases and renewals, and I'll touch on the acquisitions and the disposals. I'll also touch a little bit on the CAPEX, and lastly touch on the vacancies. Three-quarters of our income comes from government, as Sandile articulated earlier. Within that 76%, we have 4 different spheres of government in there. We've got national making up about 40% or 37% to be precise. We have provincial government departments making up 20%, municipalities make up 11%, and state-owned enterprises make up the balance. We are very pleased with the 71,000 or 72,000 square meters that we've renewed. It's been predominantly in the KZN area. Most of that talks to our diversification strategy within our portfolio. Half of that 72,000 is made up of provincial leases, and the other balance is made up of state-owned enterprises. Those are the renewals that we've done. I think given the tough economic climate, it's a big number which we're very proud of. If you add the new leases and the renewals, we've done about 120,000 square meters. In terms of the new leases, we've done just under 50,000. Again, it's in the 2 key nodes that we play in. Pretoria makes up about half of those new leases. We have concluded a lease with National Department of Public Works. That is the Department of Public Enterprise, Commission House building, 7,000 square meters. As Sandile again alluded to earlier, we initially signed up a 3-year lease at 105 Rand a square. We're quite well advanced with the new leadership to get that lease agreement extended to a 10-year. The tenant department is driving the 10-year lease because they're going to spend a lot of money on TI in the building, on IT in the building, and they want to get more TI from us, hence they're pushing for a 10-year lease. The other lease that we've concluded in Pretoria is that Department of Stats built their own new headquarters. It's about 2 billion Rand, 45,000 square meter building that they built. We had them as a tenant at Delta Heights. They've moved out. We had 15,000 square meters becoming vacant, but we're very chuffed to say we managed to let that space out to a quasi-government department, which is Compensation Commission, which falls under the PIC. We managed to get a 3-year lease there, but indications are that they're building their own new head office, and it will probably take 5 years before they manage to complete their own building. The other new leases that we've done there is a 10-year Mr. Price, and we applaud our property management, Mr. Phil Afford and his team, for concluding the 10-year lease. It is initially Mr. Price taking up 2,500 square meters initially, with another 2,500 to be taken up in the next 6 months. So we've done that at about 85 rand a square meter, 8% escalation on that. The vacancies have ticked up slightly due to the two vacancies that have crept up in Bloemfontein. We have always said that in Bloemfontein, when it comes to the provincial leases, we take a bit of slack. Bloemfontein, rightly or wrongly, pursue a transformation agenda that seeks to empower local players. So for the first time in 5 years since listing, Delta has lost a tenant to the opposition. It's a new BEE property player who's managed to take a tenant from us in Sadiba, 8,000 square meters. That has contributed to the vacancies going up. Those vacancies are still within the SAPOA national average of 11.8, so we're not too overly concerned. While it looks high, and I think given the quality of our buildings and the size of our buildings, we always try and retain a 5% vacancy so that our tenants can expand and grow into our buildings and we don't lose out. With regards to the 243,000 square meters, we told you last year this time the new leasing policy was being rolled out. It initially came out in December and it was changed to April. What happened in between is that there was a cabinet reshuffle, 31 March. Our minister was redeployed sideways. Some call it a promotion from public works to sports, and we got a new minister from the police who joined us. That led to a delay in the leasing policy being rolled out. The new minister had to come to terms with the new leasing policy, and he extended the timeline to 1 June and subsequently to 1 August. So what we're told now, what has happened subsequent to all that, is that there's been a change in the leadership at DPW. DG Labantu has moved on to NHRBC, and Mr. Paul Seroti, who headed up the PMTE, his contract came to an end and it was not renewed. But thankfully, the person who's been reappointed in his place is people from the old guard. Sam Vugela, who was a DG in 2007 to 2010, at the time when the long-term leases were being signed, is back in an acting capacity as DG. Sis Lydia, who was one of the longest-serving public servants at DPW with close to 30 years' experience, has been appointed to caretaker Paul Seroti's role. Lydia was actually instrumental in 2010, 2012 in crafting the leasing policy that allowed blacklisted funds to qualify for long-term leases where they had 100% MENCO. So given that it's part of the old guard that was there when long-term leases were being signed, we're very bullish that we'll see that leasing policy being finalized. When that leasing policy is finalized, I mean, that's all leases at national. That should improve to our much talked about WALE, improving to between 5 to 7 years. That slide just serves to show you that Delta is represented in all 9 provinces, and also shows you the caliber of our tenants that we have in the 4 different spheres that we talk about. We show our SOEs, and we call them blue chip tenants, though some may argue about the blue in some of those SOEs that are there. The next couple of slides just show where Delta properties are located. I think it vindicates us. We bought our buildings well. In Pretoria, where the SAPOA vacancy is sitting at 10%, we're sitting at about 8%, well below that average. And again, given that we keep some vacancies for growth for our tenants, we're not too overly concerned with the 8% vacancy in Pretoria. That's just a graphic description where you can actually see, if you take a close look at the bulkiness of our buildings. As again Sandile alluded to earlier, it is hard to find alternative bulky premises in those nodes. And in fact, what we do, we make it our business to know and understand what our competition is. So building number 15, or Middlestad, is a building that we know is vacant. And when we're negotiating, we're mindful of what the competition is out there. But some would argue that the size of our buildings allows us to dictate the market rates going forward. Number 18 is where the city of Tshwane has built their 2.5 billion Monitoria City of Tshwane house. And number 9 is a building of ours that is City of Tshwane as a tenant. We're currently well advanced in getting a new lease agreement for that tenant. In Durban, if you look around, you can see that our buildings, again, were bought well. Most of our buildings are within walking distance of the city hall, and it makes it easier for the tenants in terms of transport and that kind of thing. While in Bloemfontein, our buildings are well located, the local transformation agenda does tend to trump us up. Our CEO has been engaged with the leadership at provincial level to try and get the leases renewed. We are making some traction, but it is moving across quite slowly. Notwithstanding that, we've also received some unsolicited offers from the Free State Development Corporation that is looking to partner with local players to acquire some of the buildings and get the leases done there. So we'll continue evaluating that as we go forward. This slide here, the portfolio breakdown, without wanting to repeat what has been touched on earlier, has got some things that keep us wide awake at night. I think the biggest one is our weighted average lease expiry, which is currently sitting at 1.8. If you zone into the sovereign, it's worrying at 1.5 years. But when we get the 243,000 square meter renewed, that should see that number ticking up, and our Provin Godan will be able to raise more capital that we can put into the capex. The vacancies are 11.3. Again, that's not a huge worry to us, but we continue trying to market that. The average rental at 114 is prior to the renewals going in. Depending on where we end up with the 243,000 square meters, that number may well tick down as we renew the leases. But we'll end up probably getting a mixed bag of lease renewals in the national. The next slide just shows a sectoral split of the portfolio. 3/4 of our income comes from government. The next slide shows you the makeup that I touched on earlier, that 37% comes from national departments, with 20% coming from our provincial, 11% coming from our municipalities, local government, and the balance coming from our SOEs. It was touched on earlier again, there's been some serious changes at DPW. Firstly, with the minister changing in March, and then the 3 key people that were involved in the implementation of the policy have all moved on. Paul Seroti, his contract has expired. DG Labantu has moved on to NHBRC, and Mandla Sitole, who came from finance, has moved back to finance. But we take comfort in that the team that has come back is a team that is very much pro-transformation, and we believe they will roll out the transformation agenda. I think I've touched on that. Government tenants are generally sticky. As I came in this morning, I drove past Centum Police Station, and if you think about it, for most of us, Centum Police Station has been there from the time we all moved to Johannesburg. If you look at the Randburg Home Office, that Home Office has been located in Randburg, just showing that government departments generally do not move. The costs of relocating are exorbitant, and they generally try and stay where they are. So if you look after the building, give them quality accommodation, they generally tend to stay in the buildings. In terms of our business strategy, we'll continue focusing on our sovereign. We've managed to maintain our high tenancy retention, and in the last 5 years, we've only lost 2 tenants to the opposition. The other places where we've lost tenants is in Eskom, that Chanel touched on earlier, but there Eskom was relocating into Megawatt Park, which is their own building. And Department of Stats was moving into their own building, so we're not overly concerned about that move. The DPW task team is made up of people in the organization from all levels that engage with DPW at all levels. We have people like Bramos Sekoko, who we took from Public Works. He's done very well at Public Works, and some may say We're weakening DPW by taking their key people, but Moses was on a contract and his contract had expired, and all the major listed funds were headhunting him. So we managed to get him to come across to Delta. In Durban, we've got Sis Nozugo, who's joined us from DPW in the provincial side, that side. In terms of disposals, we've done about 4, which is the 140 that Chanil spoke about, but we had one asset at Presidia, which transferred last week, and that takes us to the 250 million rand. Of all the assets that have transferred, there were really some non-core. We had lost tenants. Some of the tenants had indicated they're not renewing the leases, so we're quite chuffed with the 7% haircut that we took on those assets, given that they had no leases and the tenants were moving out. We have a further 5 assets totaling some 371, which have been signed and concluded and are going through the motions in terms of transfer. We envisage that those 5 assets will be transferred by the end of the year, going to end of early January, given the upcoming holidays. In there is one of our crown jewels, Block G. Some would question why we sold Block G. Block G is a building of some 8,000 square meters in Pretoria. It forms part of the DTI campus, where there's 8 buildings. It is the only building that does not belong to the concession holders, and they've paid a premium from the building. We managed to get a yield of 7%, and that has helped us. So in those 5 assets that are under offer, you'll find that we fared fairly well and did not take a haircut on those 5. This slide just adds a little bit color into some of the 72,000 square meters that we are beating our drums on. The value of those 72,000 square meters is just under 250 million rand. As you can see, it's predominantly all our assets in KZN, barring Temo Towers, which is a building in Polokwane. Temo Towers, we took a reversion, but the rental we achieved at 135 rand a square is something that we're quite proud of. We got a 3-year lease at 135 rand a square meter. SARS is currently going through a rationalization following the austerity measures at SOEs, but we managed to conclude a 5-year lease at Sleepy Hollow in Pietermaritzburg at rentals of about 105. Sandra? And then the next slide shows that we've done, in spite of the challenging economic environment, we've concluded 40 new leases of about 50,000 square meters with a value of just under 200 million. In there, again, you can see that the bulk of those renewals, about 80% of them, emanate from our 2 nodes which we've chosen to play in, being Durban and Pretoria. Compensation fund is that 3-year lease that we got from the PIC, but in our discussions with the people at PIC and compensation fund, we believe they will be around for much longer than the 3-year lease that they've signed up. With regards to public enterprise, we remain hopeful that the 10-year lease will emanate that we are pushing for. On this slide here, we just show that we've fared fairly well in our renewals. We've not done any reversions in the leases that we've renewed. Where we've taken a bit of hit is on the state-owned enterprises. You can see there we took a 17% reversion, and that speaks to the Sunninghill node, where we are struggling with our vacancies. I mean, Sunninghill node, we have 3 buildings with about 20,000 square meters with Eskom. Eskom, we've vacated one of the buildings measuring 12,000 square meters. We managed to get them to renew one of the buildings, 5 Lobedu, but we had to take a cut in rental to maintain them in the building. Our competitors in the Eskom node, in the Sunninghill node, are paying away commissions of about 300% to attract tenants. They're giving 12-month rent-free periods, and we are also reacting to the competition, which is why we've reduced our rentals down from the highs of 131 to about 109. And as we continue trying to fill the remaining balance, we might even cut that rentals down to about 75 to 80 rand a square meter. We have started engaging Eskom. SARS is a sub-tenant in Eskom, and they've been told to move out. So we had a meeting with the head of the property division at Eskom and SARS, and we are talking to them about taking up 12,000 square meters in Sunninghill. But we'll have to give them a competitive rental to be able to retain. The leasing outlook going forward is 1/3 of our portfolio expiring by February 2018. But thankfully, when the bulk lease renewal is concluded, 200,000 of those leases will be addressed, and we should see that number coming down substantially. So in terms of that bulk renewal itself, we've been told that they intend finalizing it by the end of the year. We are aware that the property sector charter, Portia Tau Sekati, is meeting with the rest of the listed funds to try and tie up the leasing policy. We're currently sitting on version 10C, which is an input from SAPOA, SABIP, all stakeholders. The only thing missing in the policy is that there's a bit of question mark around how blacklisted funds are treated. And I do know that on the 3rd of November, the likes of Rebosis, Depula, and Vugile and Delta will be meeting with Portia to finalize what we want to see and how we want the blacklisted funds to be recognized in the policy. That will happen on the 3rd of November, whereupon Portia has promised the funds that immediately thereafter she will get the minister to sign the policy. The next slide just shows a graphical representation of our lease expiry profile and just shows the split within the portfolio and the gradings of our buildings. Currently, most of our buildings are B grade, but with the capex challenges that we're facing, if the leases don't get renewed, we might very well see those B grades deteriorating into C grade, but we remain bullish that when the leases are signed, we'll be able to raise funding to deploy to capex and get the buildings renovated. In terms of acquisitions, we've not done any acquisitions post the Redefine acquisition in 2016. We've remained very much inward focused, filling up our vacancies and renewing the leases. Going forward, we'll stick to our investment strategy. When the B deal that we're working on happens, we'll continue looking at assets that are bulky in the nodes that government wants to be in and stick to the 100 million rand mark going forward. That slide just shows you the properties that have transferred. And again, it shows that these are the properties where we had lost the tenants. In Samora House, we had human settlements. They were moving out, so we sold the building as an empty building. 1 and 3 Ferreira are buildings in Nelspruit that were previously occupied by Nedbank. Nedbank moved out and we sold the buildings. Damelin House is an owner-occupied building, and the college had indicated to us that they're not interested in renewing the lease on expiry, so it was one of our non-core assets that we sold. And then Presidia House is a building in Pretoria that is currently occupied on a month-to-month by the South African Police Services. We got notice that they were moving. SAPS have DPW has bought a building of about 105,000 square meters in the center of Pretoria, where all the police departments are moving to, and that will become the new police headquarters. So that building was sold as part of a portfolio with Damelin to the Damelin College, where they'll be opening their own college there. In terms of capex, we remain focused on our defensive capex, where we try and comply, make sure that our buildings comply, where we can offer our tenants functional buildings. And then the second part of the capex is a tenant installation, where we embark on lease capex, which is backed by lease agreements. If you look, I think we took out the slide, but there's a slide that shows the buildings that we are currently doing renovations on. Those are buildings where there's lease agreements. Your Johannesburg Water, your Beacon Hill in King Williams, Commission House in Pretoria, and those kind of things. Ladies and gentlemen, thank you.
Thanks, Otis. I'm glad to. I think we've tried to squeeze as much detail as possible. Obviously, as I've said in my beginning statement, I think we are in very much uncertain times, and we're trying to give as much and be as transparent as possible to shareholders and our funding partners at the activities that are happening and the various initiatives that we're taking into place to try and make sure that we're all on the same page in terms of what the outcome is and what could be achieved if any of those initiatives do pull off. And hopefully you're getting a sense of that. I think one of the key decisions that we've had to make is, does it still make sense to be a sovereign fund in this space? The reality is that, we have taken a view that, given that we basically have survived or are continuing to survive in a continued tough environment in the sovereign space, and we've basically carved out a niche for Delta, we are looking forward to the days when the 243,000 square meters of GLA, which is plus minus about 30% of the portfolio, gets signed off. That will have a huge impact on our WALE. And should the shareholders approve the 5 billion rand or 4.7 billion rand deal, PE deal, that will certainly strengthen the balance sheet. Again, that will allow us to do the capex, which means we've got another leg up on our competitors. We certainly are thinking that we are managing the business at its worst in a worse environment, and I think any impetus from here on, I think, will definitely steer the business well. And I think what we're trying to show you is that we've got a management team that can survive not only in the good times, but certainly when there's a lot of balls in the air that need managing. And we've certainly got partners that have certainly come along in our banking founders to help us to roll over those facilities. And obviously, it becomes quite important. With regards to Delta, we need to be adaptable. I think in terms of whatever the final policy that gets signed off, we need to be adaptable in that. I think we think we've understood what the final draft has been saying. As Otis is saying, we literally are up to the minute in terms of which version is there. The last time I think we had a market pre-close with shareholders where the policy was at 10B. We are at 10C now, I think, with a discussion on the 3rd of November. So basically, we are really at the forefront, and I think we probably, out of all the listed funds, stand the most to benefit from the final signature and hopefully the execution of that policy. I think in a rapidly changing economic environment, we have communicated to shareholders previously, we've discussed it at board level, that we don't anticipate there to be any turnaround between now and 2019 when the elections are. I think if you manage to read or listen to the Minister of Finance midterm budget speech, he's predicting tough times all the way to 2020. Thankfully, we had already communicated that to some of our shareholders, that similarly the political noise or the political interference will remain part of the system, I think, for the next 2 to 3 years. But if we are able to sort out our balance sheet and sort out our leases, I think the politics don't really come in and into the business. The business takes care of itself. Our tenants have shown that they are very, very sticky, as Otis has already mentioned, and it's something that I think the least we could do is make sure that we spend money on capex on these buildings. On the refinancing front, I think there's a big push. The CFO did mention there that we've got 1.1 billion early next year, first quarter next year, that is coming up. And by that stage, we hope that certainly our LTV would have dropped and the balance sheet would be looking a lot stronger to make sure that any negotiations with the funders is basically on an equal footing. The one thing that has been definitely consistent amongst all our banking partners is the improvement on the WALE. So a lot of effort has been put into that, and hopefully we can bring that through to fruition. It has taken us about 2 years to get to the policy where we are now. I think there has been some progress made on the disposals, and I think that is something that we'll obviously endeavour. But as we already mentioned, the easier assets have already been sold, and we'll try and find alternative buyers in the market. It is tough. It's tough. I think the deals like Block G of 7% disposals, I think those are just once in a blue moon type of transactions. I don't think we're going to see those type of transactions come up. And I think it's only because that particular transaction, that particular building, as Otis has mentioned, is quite key to the Department of Trade and Industry. On the leasing side, I think we cannot stress enough in terms of how much work has gone into to achieve the combined 120,000 square meters of GLA between the 72,000 square meters of renewals and the 48,000 square meters of new leases. I think in this tough economic environment, I think that's definitely is a job well done. And again, it goes to show in terms of we really have our finger on the pulse. We not only have been focusing on the potential BE transaction, but we've been focusing on making sure that the business is taking over ultimately for either the leasing policy to come through or the funding that we anticipate from the BE transaction. As far as the outlook, I think we obviously will probably have more airtime once that we get a lot more certainty on the BE transaction and the benefits thereof. So I don't want to focus too much on that point and preempt that. There will obviously be a circular once we know the terms and conditions from our funders. We do have an indication based on the committee that set last week Monday in terms of where the pricing may be and what are the conditions of that. And I think, I think we're bullish. I think chatting to that particular team within the funders who came out, I think we definitely are hoping that we'll surprise shareholders on the upside there, particularly given where the economy is going, and I think certainly the business definitely needs it, and we definitely need to shore up the balance sheet of this company going forward. I think on that last bullet point there, I think as we've already mentioned, we remain on track. I think there's a lot of work ahead, not only in making sure that we retain our tenants. We perhaps are in a position to go to shareholders with a BEE transaction to recapitalize the balance sheet. But also, once the policy gets signed off, it's getting all those leases signed off at DPW. Ladies and gentlemen, I know that we've taken a bit of time, but I think we are literally with 2 minutes to spare before the next presentation. I think we've done pretty well. Thank you very much. Is there any questions either on the webcast or in the room? Otherwise, we are available outside for those of you that want to perhaps maybe pick up on 1 or 2 points. Thank you very much for spending the 1.5 hours with us this morning. Thank you.